right, let's go ahead and begin. Okay, so good afternoon, everybody. Today it is, it's right after 3 o'clock on Monday the 27th. We had a lot of new people come in over the weekend. A lot of you guys subscribed to the YouTube channel and to our Twitch channel. So I see some of you guys are streaming from there. I thought it was only right that we go over our positions, we go over the plan, and go over some data for the end of the day. Just because we're in a new week, it's going to be a busy week. Okay, it's going to be a busy week. We've got some numbers coming out, but let's just recap what happened last week. Okay, because I think it's important that we think about the perspective here. Okay, so out of the last 10 or 11 weeks, we've had mostly red weeks. I think there was like one green week before, but in the 10 weeks before last week. But we got another green week last week, and it was a big one. We went up 6.4% on the S&P 500, about 7.4% on the NASDAQ. Friday's gain of 3% on the S&P was the biggest one since May 2020, all right? This is very typical of bear markets. We see bear market rallies, okay? When do we know that, this is a bear market rally or this is a rally that's going to stay? I mean, there's no such thing as getting in the real bottom. Okay. If you can get into a level of value, that may make sense, but there's no such thing as picking the exact bottom. So, when will we know? I think, maybe in the coming weeks we may know, but I think that this is a problem that is going to stay with us for a bit. Inflation is just one of those things that stays with us for a while. You guys that have been with me for a while, that I've always compared this time period to the 1970s. And in the 70s, inflation started in, 71, 72, but it wasn't until 79, 80, until 81 where we've had inflation really come down. The market started going up in 79 though. Because markets are forward looking, okay? But right now, the main trend is down, okay? Big picture, the main trend is down. We had a bear market rally in May and June. It looks like we're having a little bear market rally here. Will it continue? It's hard to say. Manage risk accordingly. Again, our plan for the indices is we have certain value levels that we're looking at, okay? Those are value levels where we can go long, and then we have levels where we want to go short, okay? Long-term share accumulation, I think it's a good idea to start dollar cost averaging once we get into that 342 zone and lower, okay? So again, 342 zone and lower. I may even try to buy some calls around this level, scaling in, 6 months to a year dated, so longer dated, because who knows, we could chop around the bottom for a bit and then resume up. Okay, it's not going to be a V recovery. Okay, and I've said this from many weeks ago. The reason why it's not going to be a V recovery is because bond yields are now at decent levels. There's competition. The Tina effect, there is no alternative. That effect is less pronounced when interest rates are at reasonable levels. Also, cash with its uptrend, the dollar with its uptrend, that is now an alternative, okay? So equities have competition now for money, all right? But I do think for long-term shares, it makes sense to start dollar cost averaging at 342 on down. I've told a lot of you this, that my main portfolio is SPY shares, okay? I continuously sell premium against my SPY shares. That premium is what I use to hedge my portfolio and speculate. So all that money that I generate from selling premium, I put it into a separate account. I call it my spec account, and my spec account is where I hedge and where I also speculate as well. Okay, so once you get to a certain number of shares, you don't really care what the dollar per share is. All you care about is that you want to hold these shares forever for, for tax implications and also just for wealth generation, but you know that you're going to generate income for the rest of your life on these shares. Where's the S&P 500 ever going to go? Is it ever going to go to zero? No. It's the 500 largest companies in the world, okay? If there are some weaker components, they will get replaced with stronger components. It's evolution. It's self-correcting code, okay? So that is why SPY is a good forever asset. I know that I'm going to generate at least 10% income, very low risk from my portfolios for the rest of my life every year. Okay, that is the money that I use to hedge and speculate. All right, so long-term accumulation, I think it makes a lot of sense to start accumulating down here for long-term holds to increase your share count. If okay, we don't know, I can't tell the future. I always keep telling everybody this. It's not about trying to predict the future. You're trying to anticipate what may happen. Okay, you're just trying to anticipate what may happen. Just like playing chess. We call ourselves checkmate trading here. It's like playing chess. You don't know exactly what your opponent is going to do, but you can anticipate 5 or 6 moves ahead, and just in case if he does one of your anticipations, you're ready, right? So it's the same thing here. All right. If it just goes straight down, yes, we're going to start accumulating shares and accumulating some long-dated calls. But if this rally continues and we get into that, I would say 405 to 415 zone, I am going to scale into some 6-month put vertical debit spreads. Okay, I'm going to 3 to 6 months out, either on the IWM, which is the small caps ETF, or the Triple Q, which is the U.S. tech index, the NASDAQ proxy ETF. Okay, those are the most credit sensitive areas in the market. So if we sell off, I think those will sell off faster. So I will be building put walls or put vertical debit spreads there, okay? And a put vertical debit spread, you can Google this, but basically you're buying a closer at the money put in this example, and then you're selling a further out the money call. Actually, let's go and let me show you an example of this, okay? Let me show you one of my positions. FXI. I legged into more of this, by the way. It's all on Discord. Go to the Discord, go to the equity indices channel. I put in there that I legged into more of this, okay? But anyway, I'll get to that soon. But this is what a put vertical debit spread is, all right? Closer to at the money, you're buying. Further out the money, you're selling. Same expiration. Okay, so this is a bearish position. You can also do it on the call side. You would be buying closer at the money and selling further out the money. Okay, and that would be a bullish position. I'm not bullish on China. I'm kind of bearish. Okay, so this is a hedged bearish position. Okay, so if you're wrong, and if the implied volatility sucks out some of that premium value out of the option that you're long on, well, at least the option that you're short on is also depreciating. So, it doesn't wash out completely by no means, but it does reduce your losses. It reduces the amount of premium you put into it, and also reduces your losses from IV crush or from some delta loss. Okay, so that's why I prefer doing those, all right, for right now, because the reason why right now I'm using spreads is because the VIX is high. The VIX kind of tells you the implied volatility of the S&P 500 index. So it tells you how expensive options are. Options are pretty expensive right now, with the VIX hovering around 30, high 20s, 30s. People are so accustomed to the VIX being this high. This is high, okay? The average is usually around 14 or 15. All right. We had some lows back in 2017 where it went under 10. That's very super rare. I don't think it's ever happened like that. It was like down in the 8s at one point, but the high 20s, 30s, that's considered quite high. Okay. So there's a lot of expectation for movement that's implied by the prices of options. Okay. China, we'll get back to that soon. All right. But anyway, I am building those put vertical debit spreads, which are bearish positions, if we were to go up to that 405 to 410 zone. Okay, let's just call it 405 to 415 or so. Okay, right there, I'm going to start building put walls. All right, for 6 months away, put vertical debit spreads. All right, or if we just go straight down, I'm going to start legging into shares here, here, and here. And also at the same time, I'm also going to buy some calls that are 6 to 1 month out, around at the money or in the money. Okay. So that is my plan for the indices. Okay. We had a great week, for indices, so it looks like that 360 area was at least a short-term buy the dip. I think we still have some more room to go down, but, that may not come for a while. It just depends. Back in the 70s also, too, we had this lost decade of asset prices, basically from 69 to 79, lost decade, right? But in that bear market, we had times where we had bear market rallies, and some of these bear market rallies turned into mini bull markets that would last for about a year or so, and then the bigger macro trend would continue, and the sell-off would continue. So that definitely is possible. Again, I'm not trying to tell the future. I'm just trying to anticipate what may be. I think you just have to be ready for that, okay? So even though if we go here, I scale into some put walls, I'm going to be managing my risk. So if I start seeing that the economic conditions are getting better, junk bond liquidity is entering, credit liquidity is increasing, and we start getting over that 430, yeah, I'm going to cut my losses and move on, okay? Because that means we're wrong, all right? Again, trading is not about being right or wrong. It's about making money and protecting your capital. Now, your number one job as a trader is to protect your capital and manage risk. All right? It's inevitable. We're going to be wrong at times. It's not about being perfect. There's nobody who's perfect. Okay? Every trader who's a professional, who's consistent, who's been doing this for 10 plus, 20 plus years will tell you that. Okay? It's not about being 100% right all the time. It's about protecting your capital and managing risk. All right? It looks like, based on the Fed funds rate expectation, it looks like for this cycle, the expectation for the Fed funds rate is about 3.5%. Okay. Right before the June FOMC, however, it went as high as 4.1% expectation. And a lot of that, I think, has to do with Jay Powell's testimony last week in Congress. He used the term data dependent, which is a dovish term. Okay, whenever the Fed says data dependent, it's usually seen on as dovish. Okay, he didn't say like, oh, even if inflation starts, we seeing peak inflation signs, we're still going to continue to make sure inflation is stomped out. He didn't say anything like that. Okay, or along those lines. He didn't say that. He said they're going to take a data dependent approach, which I think lowered the expectation of increased rate hikes. Okay, so I think right now the market is thinking like, oh, it's going to be status quo. Whatever is announced is probably what's going to happen. They're not really anticipating any surprise rate hikes for this year at least. Okay, and I think it's because of that. A lot changed during that testimony. Also, too, Bullard, which is one of the Fed governors, he also was sounding dovish and more optimistic about the possibilities around recessions here in the United States. So also that tempered and cooled down the markets a little bit. This is also just like the 70s, okay? We would get Volcker didn't come in until 79, by the way. There were all these other Fed chairmen before, and they would tighten, and then it would go from this inflation fear to recession obsession. Okay, so first, inflation would happen, so they would tighten. Then inflation would peak, quote unquote, it would peak, and then they were afraid about hurting growth too much, and then they would loosen. Boom, inflation would come back 3-6 months, maybe even a year later, and they would have to tighten even more than what they had previously done. So that is how the Fed, got up to a 10% interest rate And then Volcker had to come in and raise it to like 16 or 20% or something like that. He had to raise it like 64 times. Okay, so it wasn't until 79 where somebody like Volcker came in and said, you know what, it doesn't, it can look like it's peaking, but we're going to stomp this out once and for all. And that's when the Fed had credibility. Okay, so the Fed had in the 70s, the Fed had credibility issues, and it wasn't until 79. And once Volcker got once he was in the job as chairman, the markets just started rallying because he signaled that he was going to be tough on inflation, and then all of a sudden there was credibility in the Fed, and people said, you know what, now that the Fed has inflation in mind and they're serious about stomping it out, let's now look toward the future. Okay, that I don't think has happened yet. Okay. On the contrary, I think history is going to rhyme like in the 70s, and I think what the Fed may end up doing is letting their foot off the gas pedal when it comes to tightening. There's already I saw somebody posted an article about some tweet about deflationary fears, and we may be seeing a Fed that's loosening. That may be the case, but if that is the case, if that happens within the next 6 months to a year, you can bet that inflation is going to come back probably toward the end of 2023 or probably 2024. And at that moment, they're going to have to tighten even more. And I've been telling you guys this for weeks. I think the worst is yet to come. I think 2024 is going to be the worst, especially if they have to deal with a budget deficit here in the United States and they have to raise taxes. Okay, because budget deficits are inflationary. So if they have to raise taxes and tighten, with monetary policy, then I mean that's probably going to be a double whammy then. Okay, again, I don't know if that's going to happen for sure. I don't have a crystal ball, neither do you, but it is a possibility that we need to think about. Okay. We'll take things one day at a time. Okay, so that's a little bit more forward looking, but I like to, I like to look about 5 or 6 moves ahead and see what we're up against. Last week, the biggest positive performers were defensive industries like healthcare and real estate, up 8.2 and 7.7% respectively. Energy recorded a rare week in the red at minus 1.5%. Okay, so let's just take a look at energy right now. This is oil, always making a little bit of a rebound. Again, the plan for weeks now has been, for us here at Checkmate Trading at least, our plan has been always that we wanted to see gasoline usage peak. All right. We wanted to see a breakdown in gasoline at around here. This is when we called the top in oil and gasoline. We called it right here in one of our live calls. I think it was the 14th or the 15th. We called it right here. It didn't give us a retrace. It just went straight down. Maybe we get a retrace here, okay? So if crude can get up to about 119 or over, boom, I'm going to start a short position right here, okay? We are targeting perhaps lower hundreds, maybe even into the 90s. At that point, what I will be using is put vertical spreads, again, on either the actual crude oil futures contract, or I may use USO, which is an ETF. The reason why I'm even considering USO is right now the put skew, the IV, the implied volatility skew on the put side on USO is pretty steep. For 3 to 6 months out, which gives me a little bit of an edge when I do a vertical debit. Okay, if you don't know what that means, I know I've gone over it in some of our videos before on put skew. I will go over it in more detail. Perhaps if I have some time after this at the end, I may go over that. But I have a lot of things I wanted to cover today for the upcoming weeks. Okay, so that's energy. All right. Speaking of energy, I'm also getting long on uranium. I've talked about this for a bit. We called the bottom on uranium too. Last week on Thursday's video, right here, I said, hey, this may be the bottom in uranium. Okay. if you look at the uranium chart, there's not a lot of charts on uranium out there. It's a very thinly traded market. Obviously, there's only a few industries that really get involved in this. If uranium miners, people that operate civilian nuclear reactors, like nuclear power generators and utilities, also governments, buy uranium. It's not like. It's not like your big household names buy it. So again, it's a very thinly traded market. So there's a lot of risks. It does carry with it political risks as well too. What if? And again, I don't know if this is going to happen. You don't either. What if the conflict in Russia and Ukraine is over and the ban on Russian uranium goes away? That could flood the market with supply. But right now I believe there's going to be a supply shock in uranium, and I think the market is already starting to see that. A lot of uranium miners, and this is just based on their earnings releases, a lot of uranium miners are not mining any excess inventory until they start getting these deals. All right. The United States government has already signaled that they're going to be buying billions of dollars worth of uranium from domestic and Western suppliers. So most likely going to be like from domestic here and in Canada. All right. Canada is a big producer of uranium as well too. Okay. At first I was talking about perhaps buying DNN, that's Denison Energy. I have decided not to do that. Instead, I want to keep my positions really, really small because I have no idea when the bottom of this is. Metals and commodities are one of those things. It doesn't have that frenzy like small stocks do. Okay, even something like uranium, I think for something like this, it may chop around for a bit, and I just want some skin in the game just to quench my FOMO, if you want to call it that. So I'm not going to do anything major or buy any shares yet. I will later on. If we get lower prices or if I get some more confirmation with future earnings releases. I think next earnings release for a lot of these uranium companies like CCJ, Cameco, I think they call it. But yeah, CCJ, UEC, DNN, which is Denison. I think all these earnings, they're coming up in the next couple of months, and I think those earnings are going to be key to see what they're doing with their excess inventory, or if they got any long-term deals signed. And that's going to give me a little bit more confirmation on what the market looks like for the uranium ore. But for now, all I did was buy some low delta leaps. What I did was I just put some bids out there for anything here. I do have, I do a lot of options pricing modeling, and so I modeled everything with a low implied volatility. So I modeled, hey, if these options with these strikes were at implied volatility, 65 or less, what price would they be? And I put those bids in. A long time. I know a lot of people, when they quote options prices, they look at the bid ask, or they look at the mark, which is between the bid ask. Amongst professionals, though, sometimes you can give quotes of options by delta or by implied volatility as well. That just tells you how much these two things affect the prices of options. Okay, so you really have to understand your Greeks, and you got to understand what implied volatility is and what that really means for your options. Okay, but I put some orders through, and it looks like the 42 was the one that hit. Not a lot, but I just a starter position. Look, I see I only got only filled on 2, so. By no means is this a lot. I'm just getting some skin in the game. It's just some low delta leaps, just in case if it starts running. I don't think it will. But what if it does? Just have a little bit of skin in the game. Not much. Okay, just a little skin in the game. Uranium has been known to make those types of big moves. It's not like gold. Uranium is one of those commodities that can have those types of shocks. It can chop around for a bit too. It may take a while for demand to really show itself because a lot of the demand really comes from power plant operators and governments. But if there is supply shocks, which uranium is is prone to have. Last time it had a supply shock there was a supply shock, I think, in the 70s and 80s. There was a supply shock in the 2000s. But whenever that happens, it's a huge spike, okay? And, back in the 70s, it went from around, $20 it went all the way up to 120. So I don't know if that's going to happen here, but if it does, and, because there's a lot of supply that's off the market because of Russia, and also because of kind of the cheap oil prices that we've had before. And I'm not talking about now. Now oil's expensive, but we've had relatively cheap oil prices before last year, and that definitely dampened demand for uranium. Okay, when fossil fuels are that cheap, there's less and less demand for uranium products. But now I think governments may be getting a little bit more friendly towards the idea of nuclear power. We shall see. Okay, just a little skin in the game. We'll see what comes out of it. All right. We do have some upcoming economic data that I think you guys should look at. The PCE, which is a inflation reading based on personal consumption, comes out on Thursday at 8:30 in the morning Eastern time, and that is the favored inflation reading of the Fed. So a lot of professionals are going to be looking at that one too. I think we may see some big moves after that. Also, Europe will have its CPI report, its core inflation report, coming out on Friday around 5 a.m. Eastern time as well. Okay. One of the things I also wanted to go over, somebody today was talking about corn. I talked about this in the last video. On Thursday's video, we basically called the top on corn, saying this is the top. I think within the grains and stuff, we had a report that came out that said, so I think this is the top right here. Okay, this area. We got data that said that, okay, let's move back. Why did we even think corn was a possibility of going up? Around in the beginning of June, I said that there was a possibility that we may see a shock in corn supplies where not a lot of corn is being planted. And if that's the case, we may see the 10-year Treasury yield spike because of an expectation of higher inflation, okay? We did not get that. We actually got the opposite. And I said we're going to hold off on that conclusion until we get the report that says that, yes, corn planting acreage is down, okay? We didn't get that. We got the opposite. Right at the last week that's possible. Corn can be planted until around mid-June, okay? But after mid-June is too late. So the report came out and it said that, yes, in fact, planters did end up planting corn, all right? Corn is very, it requires a lot of nutrients, all right, in the soil, okay? So every 1 to 2 corn plants, generally what they will do is rotate into soy, okay? Last time I said that soy was regenerative to the soil. I'm not a farming expert. There was somebody on our Discord that said that it's not necessarily regenerative, but there's some type of nitrogen nutrient that it gets into the soil, but it's still bad for the soil, whatever it may be, okay? In the end, it's all about supply and demand. Crop rotation does happen, and so it does affect supplies. And when it affects supply, when the supply and demand dynamic changes, prices change. Okay, the important thing here is that what the also too, because the price of fertilizer was also very, very high. So a lot of planters were thinking about rotating into soy this season. Well, what happened to the price of natural gas? All right, natural gas fell. All right. Why is that important? Because natural gas is one of those components in fertilizers. So a lot of fertilizer prices came down. All right. As fertilizer prices came down, farmers ended up saying, you know what, we'll go ahead and plant corn. So that's that. Okay. So that's why we always wait for the data. We don't FOMO into something. We always wait for data. Okay. I just said that after FOMOing into into uranium, but those are small. But anyway, you don't take on big trades unless you get confirmation from some type of data like that. All right, and the data came out the other way that was expected. Okay, so it looks like corn's planned. I think that by late summer they're going to revise the corn crop expectation, and probably they're going to revise the yields higher. Okay, they have fertilizer, I think, and they have the acreage. I think there's going to be a decent crop, minus some weird, like, crazy weather event happening. I don't know, a series of tornadoes, or the whole Midwest gets flooded. Minus something like that happening. I think there's going to be a decent crop in corn. Again, the plan hasn't changed. If we get to around this 770, 780 level, I am going to do a put vertical spread, which is a bearish position for the way down. Okay? Why do I, some of you are asking me, if you know this, if the data is so clear, if you're so confident about your data, why don't you get in early? Because you might miss it. You might miss the entry if you're waiting. I mean, that is true. Very true. I do miss out on a lot of trades because I do wait. But here's the reason why. No matter how accurate our data is nothing's 100%. There's no system on this planet, no system that can predict the future. Nothing is 100%. Okay? You could be 80, 90% correct, but that 10, 20% can wipe you out. Okay? It's all about risk management. First, second, third, fourth things that I think about: risk management and protection of capital. Okay? So if we were to go short here and the market retraces the breakdown, then what? Am I going to be holding it for $40 of drawdown and this is a leveraged contract, by the way. So each, this is for 1,000 bushels. So, imagine this times 1,000. All right. So am I going to really take that 7-8% drawdown by going short here? What if I'm wrong? Right? I always start with that. What if I'm wrong? Okay. And that's why I wait for this level right here. Because if I'm wrong, I'll know when I'm wrong. If we close above this, then I know I'm wrong. I'm only taking what? 20-point drawdown. So, I'm willing to have my spreads go against me for a 2.5% move rather than a 4% move, 4.5%, 5% move. Okay. That makes this is much more painful of a drawdown to hold on to see if I'm wrong rather than this. If I'm wrong, I know it's a smaller loss. Boom, I'm out. Okay? And again, that's what's most important. Keep your losses small. Keep your winners riding. Okay? Win big, lose small. All right? That's basically the secret to trading right there. It's not really a secret. It just requires a lot of patience. And most people don't have that. Most people don't have the patience and discipline to wait for these things or just let it go. Most people FOMO. All right. I always kept saying, what is the term that I always say? JOMO, joy of missing out. Sometimes you just got to enjoy missing out. All right. It is what it is. Risk management. Okay. First, second, and third thing you think about: risk management and protection of capital. So no matter how much I rely on my data, I'm still going to go to a point where I can tell from price action that I'm going to be wrong. So if I short here and if it closes above there, well, at least, it is what it is. I get out of a short loss, a very, very small loss. Okay. If I short here and it retraces, I'm not sure if I'm going to be wrong until it goes over. I mean, that is a miserable time. And not only is my financial capital going to be hurt, my mental capital is going to be hurt. You can always make back your money, but sometimes you can't always get back your self-confidence, okay, to trade again, all right? Mental capital. You have to preserve not only your financial capital, but your mental capital as well. Okay, so that's the plan. I plan on shorting corn and shorting oil at higher levels. I think the tops are in for both. Okay, that's just a recap from last time for those who didn't watch the video last week. All right, let's just go over some data. Okay, dollar. All right, dollar. Oops, dollar right here. King dollar was making its lows, then it recovered. Okay. The dollar, I think, is going to stay around here for a bit until we get the CPI report coming out in 2 weeks. I think it's that July 13th weekend, July 13th, I think, is when is a Wednesday, I believe. That's the Wednesday where the CPI report comes out. I might be wrong. I'll check that and revise that for the next video. But I think it may chop around here for a bit. If it drops hard, that's not going to be good for our EEM. EEM, I scaled more into this, by the way, too. You can, again, it's on the indices. Just so you guys know that I'm not lying to you guys. I would never. Hopefully by this point, you guys trust me enough to know that whenever, whenever I post a trade, I take it myself. Okay, I'm not a sensationalist. I always try to give you the straight data, straightforward. I hope at this point you trust me enough for that. But yes, I did add some more into this. I'm scaling slowly, just daily, 1 to 2 contracts at a time daily, probably for the next 2 to 3 weeks. These are for March, okay? So I got time on these, all right? So I'm willing to take it very slowly for this because you never know. So these things, the thesis here is that as the dollar goes up, okay, most debt is denominated in dollars, all right? So when the dollar goes up, it becomes more expensive to service debt. All right, so a lot of companies in emerging markets tend to have reduced cash flow because they're so, because the debt servicing costs are higher. Not only that, most commodities are also denominated in dollars as well too. Oil and food commodities are already very, very expensive. Not only that, but the dollar's expensive at the same time. It's like a double whammy on raw materials, okay? And a lot of emerging markets, they import those raw materials, all right? So that's why, generally when the dollar goes up, it puts downward pressure on emerging markets and stocks in the emerging markets, okay? So that's why, that's my thesis on EEM, okay? The dollar may come down a little bit. It may, make a little local low, but, that's why I have it dated so long, okay? Because I know that this may take a while to really manifest itself. It's already starting to happen. You're already starting to see cracks in emerging markets. Look at Sri Lanka. Sri Lanka had these crazy riots. They're having food shortages, energy shortages. They're already introducing, they're already asking people to use less energy in places like Pakistan and other countries. So it's already started. It usually starts with 1 or 2 countries and then it spreads everywhere. Latin America, Turkey, Greece, Southeast Asia, all these countries will start getting affected. Even countries that are not really considered emerging markets, but are fairly wealthy, like places like Hong Kong, they will also have to start initiating a tightening as well too. Hong Kong is one of those places that doesn't have a central bank that issues currency. They have a currency board and they try to peg their currency, the Hong Kong dollar, to the US dollar. Right now it's losing that peg because of all the dollar because of all the tightening going on here is causing the dollar to go up. And so they're already seeing their currency getting depegged from the dollar. So at some point they will have to tighten in order to maintain that peg. Okay, so even countries like Hong Kong, even foreign countries, they may have to do some tightening. They're also represented in the EEM ETF as well too. Okay, so I think we're going to have some type of emerging market liquidity debt kind of issue in 2023. I may be wrong about the timing of that. It may be closer to the end of 2023. And if I see the data to turn too slowly, I may cut and wait to re-enter later on. But I'll let you guys know. As always, I always let you guys know what I'm thinking. So, stay tuned for that. I will keep you updated. But for now, I'm holding and I'm adding on to it, okay? I'm still about 95% in cash in my spec account. So again, I say I'm legging in, but I'm doing it extremely slowly, okay? So I did add some today. I did open up some new positions today, but I'm still about 95% in cash, okay? So doing it slowly. This is a choppy market. You got to think a little bit long term. You got to look for those multi-week, monthly moves, okay? These small day-to-day moves, you're going to get chopped out both ways, okay? That's not where the money is, all right? The money is in these bigger moves, these weekly moves, weekly, monthly moves. That's where you can lean on, okay? You can lean on that data. You can lean on that position sizing and really make a good profit on these longer-term moves. Okay, and that's what we're looking for. That's what we're trying to anticipate. Okay, again, not trying to predict the future, just trying to anticipate what may be. We're looking for these big monthly, weekly moves. Okay. Last time I also went over FXI a little bit earlier. I still have that position. Again, just in case. I still have my August. I didn't add to that. I added to these Novembers. I added to these. I have more time, and plus it's a spread. Okay. Why am I short China? I was short China from about like a week or two ago, or maybe a week ago. I don't know. You can check back on the videos and see when I posted that. But really, it's because, when China really goes down, or when China goes up, I should say, when production is going up, when things are great in China, generally the Australian dollar confirms that. Why is that? Well, because China imports a lot of minerals from Australia. They get a lot of their natural resources from Australia. So if they're building, if industrial output is high and economic activity is high, there's going to be a demand for the Australian dollar to import all those raw materials. Okay, so we did see that right here. I think this is around the time where I got long. I got long on FXI when I saw this day right here. This happened because there was a report in Shanghai that said that they were thinking about reducing the COVID restrictions. They were going to do away with some of that. There was initial news that came out of it, but then 3 days later, boom, it invalidated that. What is this green line? This green line is actually a pivot going back all the way into the 80s. It's a very key level. It's a level that's got a lot of memory to it, okay? So at first, it broke past that. It looked like a breakout. Then it was a failed breakout, okay? And that's when I said, you know what? I call BS on China's rally. And the whole thesis here is that there's always somebody smarter than you, okay? Don't you think if somebody was smart enough to know that, that China's reopening was going to be BS, that they would not long the Australian dollar, and they would short it, right? Usually in a room full of traders, your currency traders are your most talented individuals. They're the most analytical bunch. Also, too, within the central bank, also, too, don't you think that they're going to, see this? So, the whole thesis behind that is there's always somebody smarter looking at this. So, that to me told me that, hey, as a there's somebody that knows something contrary to what the news is saying. All right. And if you look back to, if you put this chart, Australian dollar, over the Chinese stock market index, it literally is like, it goes together. Okay. AUD USD leads it by, it can lead up to about a couple weeks though. Okay. It's a leading indicator. All right, in my opinion, in my view, from my studies. All right, so again, it wasn't able to pass through that. It tried to retest it. This is when China pumped liquidity over the Juneteenth weekend. They pumped a lot of money into their markets, and we saw the Australian dollar go up, but it couldn't break that level. It could not break that 0.6993 level, and it just rejected. Okay, so again, I'm calling BS on this FXI rally because of this. Also, too, copper. Everybody thinks copper is a leading indicator for global growth. No, maybe 30 years ago, maybe in your grandpa's market, that was a truth. But I think in today's market, HG copper is more of a barometer for China. Okay, it's a barometer for China. It's not a barometer for the world. Okay, that age is over. Okay, so. It's this is more of a barometer for China. Okay. Again, that's more for the last 5 to 10 years. Yeah, 30. Somebody's gonna pull up a study 30 years ago and say, "Oh, well, 30 years ago it worked." Yeah, well, 30 years ago, things were different. Okay. Money moves a lot faster and ideas travel a lot faster than 30 years ago. I think we will all agree on that. Okay. What else? Oh, bond data. Yes, let's take a look at the bond data. That's the most important thing here. Really, it's where we get most of our signals from. Bonds. Move index. Move. What is move? The move index is it's like the VIX, but for bonds. Okay, the VIX calculates the implied volatility that's priced in for the next 30 days on around at the money puts and calls on the S&P 500 index. So basically what the VIX measures is how expensive are options on the S&P 500. Okay? Move is the same thing. It's the VIX on bonds. All right. I thought by now it would have closed. Bond market would be closed. Okay. Well, I know the move index, it updates only once a day. It was tracked by the exchanges a long time ago, I think before 2021, but now it's only tracked by Bank of America. I don't know why. I don't know why that is. I don't know why. But anyway, this is a good indicator of bond volatility and the need for the uncertainty around bond markets. Okay. As you can see, it's still at a pretty large high. Okay. This is not over yet. Whatever this is, whatever we're going through right now, I think it's going to be extended. I mean, the bond market is not telling us this is going to be over anytime soon. Remember this? TIP over TLT. This is inflation-protected Treasury ETF divided by long-term Treasury ETFs. What does that really mean? So if this ratio is going up, it means that inflation expectations are going up. That means that market is expecting more inflation. If it's coming down, it means deflation or inflation is coming down. Okay? Either deflation or inflation is coming down if it goes down, if this ratio goes down. Okay? We were saying that we need to break one way or another for us to give us a clear signal. Watch it just break around it. What if it just does this? I think it could, especially until CPI report on July 13th or for the end of month Fed and ECB meetings, the European Central Bank. They're only like a few sessions away from each other. So, I think it may chop around till then. So we shall see. Okay? It gapped up, though, this morning. So I thought, ooh, that might get spicy. If this breaks out to the upside, oof, that is going to be crazy. That would be crazy. Okay? So that's that. 10-year, 2-year. This is the spread between the U.S. 10-year Treasury versus 2-year. If this is negative, we are in an inverted yield curve environment. All right? Inverted yield curves. When the yield curve inverts, a lot of people say that's an recession indicator. I mean, yes and no. It could, but it doesn't work all the time. There's a lot of false positives to this. There's been many, many times where this has inverted, but then we didn't have a recession anytime soon. Okay, so there's a lot of false positives to this. What it does tell you, though, is how likely are banks going to lend and how much money are banks going to make from their lending operations. This is what that tells you. Okay, if this is inverted, it means banks lose money when they lend. Okay, and they limit lending when this inverts. Okay, which is another form of kind of credit tightening in the market. All right, when this goes up, when the 10-year is much higher than 2 years, so their longer dated bonds have a higher yield than your shorter dated bonds, and it steepens in that direction. Well, that means banks make a lot more money when they loan out, so they're more willing to loan then, and that is a loosening environment. Okay, so as you can see here, right now it's very close to like inverted. It's like close to zero. All right, so this is a form of tightening that the market does on itself, the 10-year, 2-year. Okay, because that's what banks do. Banks borrow short term, and they lend long term. Okay, think about in the United States. Think about your mortgage. 15, 30-year mortgages, right? So they banks, they use their clients' deposits, or they use, a credit facility from the Fed, or they even borrow amongst each other, but they do that on a short-term basis, and they charge you the long-term rate, okay? That's how they make their spread, their interest rate spread, okay? If that's not positive, they're not making a lot of money. They might be potentially losing money. All right. So that's why I monitor this. All right. If this starts going up, we're going to see a lot more participation from the banks in this rally, and then we can have a more sustained rally, most likely. Okay. Give me 1 second. Let me update something real quick. All right, sorry about that. I'm back. Okay. All right. So that didn't work. Well, I'll go over that later on. But okay. So yes. So this is the main things I look at for credit. I look at the MOVE index, which is the volatility that's in the bond markets. All right. It hasn't updated yet. Bond market is closed, but it hasn't updated yet. I do look at TIP TLT. All right. I do look at the 10-year, 2-year. I also look at junk bonds, advance and declines. Okay. This is more of a newer technique that I learned. I learned this from somebody else, actually. None of the stuff that I do, by the way, is new. Some of the stuff that I'm looking at has been around for like decades. Okay. Looking at the dollar, looking at TIP over TLT, looking at the MOVE index. I mean, I off the top of my head, I know people in the 60s and 70s who wrote about this kind of stuff. So this is not new stuff by any means. People think I'm a wizard for coming up with all this stuff. I didn't come up with any of this. Okay, this is all, public information. So look at my data sources, FINRA website, the charts, the Federal Reserve Government Education website, the FRED, the St. Louis FRED website. These are all public and free. So that's where I get a lot of the data from. You can get it for free too. Now it's another thing to interpret it though, but that's what I'm here for. Okay. This is updates once a day at the end of the day. What I'm looking for is more advances than declines. Friday was the first day I saw major advances over declines. Will that continue? We shall see. Okay, one day does not make a trend. One day does not break a trend. So we will see what happens. Okay, I think it probably is going to update in about 8 minutes or so. So maybe we stay here for a bit. Maybe we talk about some other markets as well too. That is a quick rundown of a summary of our positions, of our outlook, of the data that we look at on a daily basis. Do you guys have any questions? Sorry, OPDE, I had to mute you there for a second. You were on a hot mic. I heard some stuff in the background, so I just muted you just temporarily. You're unmuted now. We are streaming live on Twitch and YouTube, but your voices will not be picked up in the recording or on the live stream, okay? It's only my voice, all right? But if you guys want to, you can take yourselves off mute, or you can, if you're not comfortable sharing your beautiful sounding voice, you can type your questions in the voice chat text. Anybody have any questions? Okay, then in that case, let me again, just real quick, just because we only have a couple minutes left, let me go ahead and go over our positions one more time. Okay, so we are short on FXI. That's just China large cap. I do have the 31.26 vertical put spread because the Australian dollar just will not break above its pivot point. It's breaking down along with copper. So I think that this rally is kind of a false move. EEM, we're still short. We're looking at those March puts for 2023 at strike 31. I am long gold. I think gold is also about to start a major upward trend. I have the 180 200 call spread for December. Also too, I am also now long on uranium, just small lotto tickets, okay? Small lotto ticket here, 42s, low delta leaps, as well as I think there's going to be some sustained volatility going forward. So I still have my December call spreads on UVXY for the 15-20 vertical call spreads. Okay, so that is the rundown on our current positions. I will be looking to short corn and oil at higher levels. Corn at around 780, 785. Also oil around 119 or higher. Okay. So that is the outlook, the expected trades, and our current positioning. Just a little rundown real quick. Nope, you're all good, OPDE. You're all good. You're all good. Don't worry about it, man. Don't worry about it. We're all here to learn. It's all good. Anybody else want to look at anything else? We've got 4 minutes left. I'm going to stay on here and keep streaming because I want to see that move index update. Let me see if they update it. The bond market is closed. Oh, VIX, you want to see the VIX? VIX is right here, but let's blow it up here. LT, good to see you again today, brother. It's okay. Sure. Yeah, here's the VIX. VIX is trending down. We will see. It's still pretty high. I mean, like I said before, it's still. See what the average. Even I mean, this is look at the last. What is it? Since 2006, it usually hovers around here, between 15 and 19 or so. When it gets low, it went down here, 10s, 11s. When it gets high, it gets into the 30s, sometimes even higher. Okay, so we are at a high point in the VIX. All right. That doesn't mean it can't go higher, though. So we'll see. I do expect. Yeah, I do. I mean, I'm positioned for a VIX spike before the end of the year. So I'm in the same boat with you all. But again, risk management is key. I kept it really small. If I'm wrong, we take a small loss. We move on to the next trade, okay? My mentor taught me this. My first trading mentor when I entered Wall Street, when it comes to trades, some will, some won't. So what? Something else is waiting. Okay, it's the 4 SWs. All right. Some will, some won't. Some you will win, some you won't. So what? There's another trade that's waiting for you. Okay. Always have that kind of mentality. Okay. It's just a trade. We move on. Okay. We manage risk. All right. So that is that. We'll see what happens. Let's actually take a look at. I want to take a look at Contango. There is a beautiful resource called VIX Central. It's free, totally free. Guy's awesome. This guy, whoever did this, he made this like years ago, like a decade ago. I know a lot of professionals who even use this too. Institutional professionals will use this sometimes. I mean, of course, they can do this on their own platform too, but this is just a good way, just on your phone or something when you're on the go. We are starting to see Contango. So that is headwinds for UVXY, any type of ETF that has a futures rolling strategy. Whenever there is Contango, that means the front month is lower than the future month. There is a decay on your ETF. ETFs that use a rolling strategy, and there is a backwardation, which means the front month is higher than the back month. Like right here, for example, there's backwardation here, but not on the front. It's more on the later months. But if your front month looked like this, where it was higher and then it went down, there would actually be tailwind for your ETF, because as you roll, you're rolling into a cheaper contract, so you got more contracts. Okay. Anyway, the VIX term structure, it looks like this right now. It's still very high. Contango is still quite low. We'll see. We may get back to backwardation if we get a VIX spike. I don't know. But right now, Contango is low enough where holding my UVXY call spread is not so bad. Now, if this widens to like 5 or 6%, I may have to rethink things. I may have to get out of that. I mean, it's still super small, but I don't want to hold it if Contango gets to 5, 6% or more. Okay? We'll see. I'll take it one day at a time. But that is what I see. Any other questions? Move index. Oh, market's over. Okay. Why is it not giving me the move index? Why is it not updating? It's not updating. Maybe updates later. Okay. What about advances and declines? Come on. There's a 15-minute delay. Where does it say? Does it say that on the site? Oh, well, again, the bond market closed about an hour ago, so that's why I thought it would be there by now. But, okay. Well, those kind of things only update once a day. This. On Thursday, this actually updated before the equity market even closed. I don't know why today is doing this. Oh, is that the new numbers? No. Actually, I think on Thinkorswim, we can also chart the move index as well. So let's see if we update it here. Maybe just trading view. Oops. Oh, it is just trading view. Maybe you're right, MSC. Maybe they don't update it until. But the bond market was closed an hour ago. It still doesn't make sense. Anyway, okay, whatever. I should just use Thinkorswim more. All right, so yeah. Okay, so here it went up. We're seeing some more bond volatility, guys. We're seeing more bond volatility. Bond volatility tends to precede stock market volatility. Okay, I know some of you guys, I saw some of you guys on the other alpha channels. I posted that visual capitalist. I'll try to post it here again on voice chat text. I know some of you guys have that visual capitalist, that diagram up on there. If you guys can find it and if you want to post it on here, be my guest. That's a wonderful visual. It shows you like the sizes of different markets, and bond markets are way bigger. They way bigger than stock markets. Okay, it's like stock market is like the little baby bro, and it's the big kid on the block is the bond market. Okay, so generally you see moves in the bond market first, or generally you can tell a lot of what the risk sentiment is going to be based on what the bond market does. Now, does this work every single time? No. Like on June 9th, for example, right after that ECB meeting, I mean, everything looked really smooth and it looked like markets were stabilizing. And all of a sudden, after that ECB meeting on the June 9th, boom, bombshell, like all the bond markets, everything just changed literally within like seconds, minutes. All right. So yeah, could data change abruptly like that? It can, but generally that's rare. And usually what you see is that bond markets will turn first before equities, before risk assets. Okay, but yes, there is that. 10-year, where did 10-year close? We're up. We are up. Okay, let's just go through the data one more time. I just want to take a look at our data. Let's see here. Our data. That probably hasn't changed. TIP TLT is still there. Okay, so I mean, that's still in no man's land, really. This went up. Let's just take a look and see where TLT is. TLT is coming down. There's going to be some decay on TLT, but that doesn't mean it can't go up a little bit. I think there might be a little bit of a relief rally. If we see a relief rally, I'd love to have an opportunity to short this. Actually, that's one trade I should have taken earlier in the year that I didn't. We saw this coming, all right? We saw this coming, all right? But we did nothing about it. See, there's a difference between being right and making money. Totally different. You can be right all day, but you can be broke. It's about it's discipline of knowing what to look for and acting upon it, okay? Should have acted on it. Right here, when we talked about tightening that's going to happen and inflation, we talked about it. I remember Toasty and we talked about it in October, November, back in the old Discord, and we should have went for it. Man, that would have been a sweet payout. I mean, you could have just done that one trade, leveraged it, take a vacation, and just come back. That would have been like, what a year that would have been. Well, hindsight, 2020. All right. Any other questions? Any other questions, concerns, rude remarks, anything? No? Okay. Well, these are the types of sessions that we have here at Checkmate Trading. We try to do this at least every Tuesday, Wednesday, Thursday at noon. We have a segment called High Noon Highlights. We've been doing it consistently for the past few weeks now. Every once in a while, I'll do a video at the end of the day outside of the scheduled releases. Depending on depending on market developments, depending on any trades that we take, depending on changes in positioning or changes to the trade plan. I try to update you guys as much as possible. I will have this video up on YouTube soon. It should be there and within a few minutes. I'll put the link also on Wiretap Tapes. I will keep the Twitch stream going so that you can take a look at the charts that I'm looking at. In overnight markets, I usually monitor the currency and yield markets and overnight futures markets throughout the night, so you can see what I'm looking at and see what I'm preparing for the next day. If you have any questions, get on the Discord. We have a great network of people here. We've got a lot of people here who are very knowledgeable in their own respective asset classes or trading strategies. Use us like resources and come on by and talk trade with us. This is really all about growing the community so that we have a group of well-trained traders that can bounce ideas off of each other. That's what this is all about. Hopefully at some point we can grow to a size where perhaps we can get some sponsors and get some hedge fund level data, and we can share that with you guys. That would be great. That would be great if we can get some sponsors and get like a Bloomberg data terminal or something like that, and we just live stream that. Oh my goodness, that would, we would be on a whole different level of trading and making money then. But until then, tell your friends, have them join. It's all free. So if you can also subscribe to our YouTube and Twitch channels, that would be much appreciated. And let me know if there's anything else you want me to put on the videos. Okay. MSC, you were off of mute for a second there. You had a question or anything? Okay, it's all good. It is, and I think actually their data API access might be even more. I haven't gotten a quote for that one yet, but yeah, the Bloomberg is about 30K. There's also other other data sources I would like us to get. I'd love to get LiveVolX, but LiveVolX is like, I want to say it's like 60 or 70 grand a year. So everything that I want for us, it's going to be about 100 to 150 grand a year for all that data that I want for us. But oh my God, the just the amount of data and trading and just all the stuff that we could do with that. I mean, I think the possibilities are endless with that, really, if we can get access to that data. But that would be something worth. That'd be definitely worth it. And if we can share it with all of you all, I mean, that's the whole point of this is to get all that, be able to get all that access to that data as one day and share it with you all, and then we can really act with confidence on all our trades. The more data that we have, the more useful data we have, the more we can lean on certain trades. Okay, so that's how I feel, at least. Any other questions? Anything else you guys want to go over? Going once. Going twice. All right, we're gonna call it a day here. All right, so I'll go ahead and switch over to just Twitch, where we just stream the charts and data. I'll still hang around here for a bit, but stay safe out there, and we'll see you tomorrow at noon Eastern for High Noon Highlights. Have a great day, guys.